Hello, welcome back. Let's take a look at Intel, which reported earnings on a day that is pretty bad for the stock market today, which is down like 3.8% right now, something of that sort, Nasdaq. So it's a terrible day. Everything is crashing today. And Intel is down 7% on earnings that it reported yesterday. And let's see what they did actually before we jump into the financials, because now the stock price is sitting at $44, and I long wanted to take a look at this company for a potential hold. So we are actually going to see the financials, of course, and examine all the details. But yeah, this is a company that I wanted to add to my portfolio. I have checked it before; it had solid financials, but now at a better price. So let's see. Now, you will see here that Intel shares fell 4%, and this is what they did actually. 87 cents per share versus 81 cents per share, so they beat on EPS. Revenue 18.35 versus 18.31, also beating on revenue. The thing that was bad for them is that, first off, Intel's revenue decreased by 7% year over year. But the worst thing of what they reported wasn't this. The worst thing was actually the guidance, which, with respect to it, Intel called for adjusted second quarter earnings per share of 70 cents instead of 83 cents that was expected. However, for the full fiscal year, they lifted their adjusted earnings guidance by 10 cents to 360 per share, more than the expected 350. And so this is actually better in my book. It's just a little bit more further in time. So now let's take a look at what the company is doing financially here, and also the key metrics of the company. So let's first take a look at the PE ratio, which is sitting at 9.7 right now. Obviously a very low PE ratio, especially for a company like Intel, yet their price to free cash flow ratio is a little bit more elevated. Now, this is marginally green here, to less than 20 is where it becomes green. So this, you can think about it as a green pretty much. Yet exactly on the threshold. Outstanding shares that are a little bit down. The company has been buying back shares. Great thing to see. Free cash flow to total liabilities, meaning that the company would take about 7.5 years of its last year's free cash flow to pay back all their total liabilities. This is a little bit elevated, but it's probably fine. We'll examine this in detail in terms of the debt. And 5-year revenue growth, again, this company is a behemoth, it's a very, very big company. You can't expect it to increase their revenue tremendously. 25.9% I think is very fair, really, when you are sitting at 62 billion and up, and right now at 80 billion. You cannot expect insane revenue increases. Now, 5-year net income growth at 107%, that's much better, although it was mostly due to 1 year, and then it stayed solid though, that's a good thing. And the free cash flow growth has been going down a little bit. Especially, this year we'll examine maybe capital expenditures. 5-year total equity growth sitting at $36 billion here, 36%, and an absolute number at $95 billion. Now, the debt to equity ratio is rather low, so this is probably less concerning right now. And the return on assets are very fair. Return on assets 11.8, and then return on equity 22.7. Pretty nice here. Company pays a little bit of a dividend yield, which is slightly elevated in terms of their free cash flow payout ratio. When you compare it to the net income, it's a little bit better, much better actually. And so it looks like free cash flow is actually less than you would want it to be. Though 55% is, well, slightly elevated, they should probably be okay with it for many years to come. It is a little bit concerning though. Okay, let's take a little bit of a closer look as well at the financials of the company. Starting with the income statement, and we will see here that the company increased their financials, increased the revenue from 62 to $79 billion in the last 5 years, and also net income from 9.6 to 19.87, so that's a pretty solid increase as well. What about the balance sheet? The balance sheet of the company, we want to take a look at the total liabilities, for example, sitting at 73 billion and total assets at 168 with a total equity of 95 from 70 almost. Another pretty solid increase in total equity here for the company. Very nice to see. And they haven't been issuing shares pretty much, and so that's a great thing to see for a company making money out of their operations. Now look at this, the net income over here from 9 billion, it went 21 here 20, and pretty much 20 again. So a little bit of a decrease here, but sitting at similar levels as you can see. A lot of depreciation and amortization added back to the net cash provided by operating activities, and this becomes free cash flow when you deduct my capital expenditures from it. And you kind of see here what I was talking about earlier, 20 billion in capital expenditures here, mostly about investments in property, plant and equipment. So I'm generally speaking fine with those. These are these are important for the business, and the company is still cash flow positive, so that's a nice thing to see. A lot of purchasing of investments as well. Dividends paid were 5.6 billion, and you can understand that when you get this number 5.6 billion and compare it to the net income of the company, is like what we saw earlier, like 30 something percent or 25 something of that sort, when you actually do the ratio. But when you compare it to the free cash flow is actually over here 9.6 billion, and so obviously it's less than the net income. And you will see here that it gives you a free cash flow which is like a FCF dividend payout ratio, and it becomes about 55% when you compare it to the dividends paid, this value to this value pretty much. And this is exactly why we saw this number over here. Remember, in the stock analysis metrics pretty much, we kind of saw this number over here, the free cash flow dividend payout ratio, which is more elevated because we have less free cash flow than net income. Now, when there is a solid difference, it may mean that the profitability of the company may not be put to good use, is what this could potentially point out. But you can see, for instance, let's just examine the previous years. Oops, I clicked the wrong one. Cash flow statement. Like this one was 35 billion over here, and this is 20 billion. This was 33 billion, and this is 16 billion. So you constantly see that the company is following a similar metric here, a similar pattern. 14 billion over here to 21. This is a bit better. 10 billion to 9 billion. This is actually much better. And so the thing that changes through the years is the increase in capital expenditures, if you exclude this year. But after that, it's basically pretty much increasing every year, annually, a lot of extra increases in capital expenditures. And this is, for the most part, what causes the steep increase here. And also the company has some depreciation amortization also that gives this extra free cash flow. It's good to know these things because you can see how the company utilizes their net income to produce free cash flow, and this will give us the actual ratios. When we take a look at our stock evaluation tool here, it will show us our margins. First of all, though, let's take a look at the revenue growth averages. Again, you can't expect this company to be growing tremendously. It's already been up quite some, so I have to go relatively low. I'm going to go 3, 5, and 7 here. Actually, this is 7 may be a little bit too high even, because it hasn't been achieved by the company. Let's actually go a little bit more conservative, 2, 4, and 6. Net income margins about the same every year, as you see, apart from this one, but overall we're doing these numbers. So it makes a ton of sense to use 24, 25, maybe 26 and 28, and see how that works, because we do have some years that are 29. And free cash flow margin, as you'll see here, as what I was saying a little bit earlier, like this one, for instance, is a little bit less than you would like it to be. But overall, we have like 80, 100, 67, 107. So I think I'm fine with going like 80, 90, and 100 for this one. I think it makes a ton of sense. We could even go a little bit more, although we did have a couple of years and also this year. So I think it makes sense to follow this one, be near this one. And we can try even lower values, really. And an annual return of 13% is what I want to make for the next 5 years, because I can make 10% out of an S&P 500 ETF or index fund. And so let's hit calculate and see what we get. I don't think I hit that. Okay, so the current price is sitting at $44, and our low max price to pay now is 43.79. Our medium 71, our high 93. So you are seeing that we are sitting at a price that is very low compared to what we should be paying based on these projections here. And if I even go a little bit more conservative here, and let's just go 50, 60, and 70, because we have some evidence of the company potentially not doing great in terms of the margins here. Now, if we hit calculate, it's only the low one that becomes much lower. And remember, we dropped it a lot over here, like 50% free cash flow margin is like this one. It's only this year, the last year, that was bad in terms of this conversion for the most part, in terms of this ratio. So the previous years, it's at least like close to 60 to 70%. 67 was the last one. So yeah, so pretty much This medium one makes more sense if you are looking to be a little bit more conservative, I'd say, which is still a buy though. And if we go, let's just say that we go back to our 80, 90, and 100, which is rather fair, we can go a little bit higher in terms of the potential revenue growth. If the company makes like 3, 5, and 7, picks up a little bit, and we hit calculate here, and then we're seeing that even more, even better values here. We're at an even higher max price to pay for all of our estimates, and it's a solid green. And yeah, this is a company that I would definitely look into to add to my portfolio. It's one company that I definitely want to add. The only thing I don't like about it is that it's paying dividends. I'm not a huge fan of dividends, and they are a little bit much when compared to the FCF payout ratio. But I don't think there is much concern, to tell you the truth, in terms of lowering the dividend, at least for now. Although, yeah, I'd potentially feel a little bit better if they were not paying the dividend, to tell you the truth. I'm not so much for the dividends because they are tax inefficient. They are taxed 2 times. One time when they're made from the corporation, and then when they're paid back to you. So hope that video helps a little bit, and hope you either got some of the stock or you have made some good gains on this one. Let me know whether you like Intel, what are you thinking about it, and please leave a like if you like the video, and remember to subscribe if you are around and want to watch the rest of our content. Thanks for watching this one again, and you can also watch the other video that I made, and in that one I'm discussing Amazon's report and why they failed, what went wrong. Thanks for watching, see you soon, bye bye.